Imagine this. A father works 40 years, buys a house in 1987 for $62,000, watches it grow, slowly at first, then faster than he ever expected. By 2024, that same house is worth $740,000. He's in his mid-70s. His knees hurt, the yard is too big, and he wants to keep that house in the family, so he does what feels natural, what feels generous. He calls his daughter, sits her down at the kitchen table and says, "I'm going to sell you this house for $1." His daughter cries. She hugs him. The family celebrates. And then, 18 months later, she gets a tax bill that nearly destroys her financially. Here's the number that changes everything. $169,000. That's what she owed in capital gains taxes, on a house she paid $1 for. How is that possible? How does selling something for $1 create a six-figure tax liability? And why do thousands of well-meaning families make this mistake every year? Because nobody ever told them how the system actually works. That's what this video is about. Because the dollar house transfer isn't a clever trick, it's a capital gains bomb. To understand why this is a catastrophic mistake, you first need to understand a concept called the cost basis. The cost basis is the original price you paid for an asset. It's the starting point for calculating tax when that asset is sold. In 1987, $62,000 became your cost basis. As the house appreciated, the gap between that basis and market value grew wider. That gap is called unrealized capital gains. Now here's where it gets interesting. The stepped-up basis at death. When you inherit a house, your cost basis is automatically reset to the fair market value on the date of death. If the daughter inherits the house, her basis becomes $740,000. She could sell it the next day and pay zero capital gains tax. $678,000 of gains would be permanently erased, tax-free. The IRS calls this a step-up. But when a parent sells for $1, the stepped-up basis vanishes. The daughter gets exactly what her father paid, $62,000. She owes tax on every dollar of growth since 1987. That's the bomb. And it's been quietly detonating in American families for decades. So where did this idea come from? Why do so many people think selling a house to a family member for $1 is smart planning? The answer goes back to a fundamental misunderstanding of gift tax versus capital gains tax, two completely separate systems. Most people have never been taught to distinguish between them. Here's the origin of the confusion. In the 1970s and 80s, estate planning became a booming industry as the post-war generation accumulated real property in large numbers. Attorneys popularized inter vivos transfers, transferring property while alive rather than through a will, to avoid probate. Probate, the legal process of validating a will after death, can be slow, public, and expensive. Anywhere from 3% to 8% of an estate's value can evaporate in probate costs and legal fees. The solution seemed elegant. Just transfer the asset now. Deed the house over to the kids. Use a nominal sale price, $1, $10, $100, to make it look like an actual transaction. Skip the courts, skip the delays, keep it in the family. And the advice wasn't entirely wrong. You can avoid probate this way. But advisors often failed to explain what they were trading away. What they were trading away was the step-up. By the 1990s, the one-house strategy had become folk wisdom, passed from neighbor to neighbor, from one well-meaning parent to the next. Entirely divorced from its tax consequences, the internet turbocharged it through forums and DIY estate planning websites. But the system has a longer memory than most families realize. The IRS doesn't care what price you listed on the deed. A transfer of property for less than fair market value is treated as a gift, and the IRS calculates the taxable gain accordingly. The IRS calculates the gain based on the original cost basis, not what was paid in the transaction. Which brings us to the next layer of the bomb. What happens when families try to fix this and discover the gift tax underneath? Instead of selling for $1, you decide to give it to your children outright as a gift. No sale, no pretense. Better, right? Not entirely. When you give an asset as a gift, the recipient takes on your original cost basis. In our example, the daughter's cost basis would still be $62,000, identical to the $1 sale scenario, so the capital gains exposure is exactly the same. Now there is a gift tax annual exclusion. In 2026, you can give up to $19,000 per person per year without filing a gift tax return. And the federal lifetime gift and estate tax exemption is enormous. Currently, $13.61 million per individual. For most middle-class families, the gift tax itself is not the immediate problem. The problem is still the basis, and it follows the asset like a shadow. Here's the second layer of confusion: the difference between gift during life and inheritance at death. A gift during life equals carryover basis, the gain survives, the tax clock keeps ticking, and inheritance at death equals a stepped-up basis. The gain is erased, the tax clock resets. This distinction is one of the most consequential in all of personal finance, and it's taught in almost no school or financial literacy course. It is explained in almost no mainstream media, until after a family has already made the mistake. Now let's talk about the numbers at scale, because this isn't just one family's problem. According to the Federal Reserve, American homeowners held approximately $32 trillion in home equity as of 2024. The National Association of Realtors estimates that roughly 20% of all home sales involve some form of intra-family transfer. That's trillions in potential cost basis exposure in millions of homes, sitting in families who believe they've handled their estate planning. Pew Research Center found that the baby boomer generation is in the midst of the largest intergenerational wealth transfer in history. An estimated $84 trillion will be passed to Gen X and millennials over the next 2 decades, mostly in real estate. And here's the statistic that should stop you cold. A 2023 survey found that fewer than 1 in 3 Americans with estates over $500,000 had consulted an estate planning attorney. The majority relied on informal advice from family, friends, or online searches for decisions worth hundreds of thousands of dollars. The capital gains bomb is a systemic, society-wide financial hazard, quietly waiting for millions of families to trigger it. And now, with home prices at historic highs in most American markets, the stakes have never been greater. A house bought in 1995 for $150,000 might be worth $900,000 today. That's $750,000 in unrealized gain. At current rates, a poorly structured transfer could trigger over $175,000 in federal taxes alone, before state taxes. And here's the twist. The fallout from poorly structured home transfers plays out in one of 3 ways. The immediate sale trap. The child receives the house via gift, the parent dies, and the child needs to sell. They receive a stepped-down basis and face a massive capital gains bill precisely when they're also grieving and closing estates. In many cases, they must sell the house just to pay the taxes on the house. The long, slow burn. The child holds onto the property, rents it out, or uses it as a vacation home. Every year they enjoy the asset, unaware that a ticking clock is running. The tax bill compounds alongside the gain. The Medicaid clawback collision. This is perhaps the most devastating scenario. Parents transfer their home to children, believing they've protected it from nursing home costs. But Medicaid's 5-year look-back period catches transfers made within 60 months of applying for benefits. If a parent needs nursing home care within 5 years of the transfer, Medicaid can essentially disqualify them from coverage. This disqualification lasts for a period proportional to the value of what was transferred, forcing families to spend down or sell their assets. They've triggered the capital gains clock and lost the Medicaid protection. In this scenario, families lose on both ends simultaneously. The IRS collects. Medicaid denies coverage. And the house, the center of the family's financial identity, must be liquidated to pay bills. As this problem became more widely known, a cottage industry of workarounds emerged. Some are legitimate, some are dangerous, most are misunderstood. The irrevocable trust. Many advisors recommend placing a home in an irrevocable trust to avoid probate while preserving the step-up basis. Using a properly structured irrevocable life insurance trust or a qualified personal residence trust can work, but irrevocable means irrevocable. Once the house is in the trust, you cannot take it back. If circumstances change, you may find yourself locked out of your own asset. The joint tenancy with right of survivorship seems simple. When the parent dies, The child automatically receives the property without probate. But here's the problem. Only the inherited portion of the basis gets stepped up, leaving the child's original share exposed to taxes. The revocable living trust is the gold standard. It allows parents to retain full control during their lifetime and avoids probate entirely. Critically, it preserves the stepped-up basis because the transfer happens at death. The house is never gifted. It is inherited via the trust. The trap is failing to properly fund the trust. If you never retitle the house, it falls into probate anyway, rendering the planning useless. This pattern of well-intentioned decisions made without full information is not unique to real estate. It happened with stretch IRAs too. Strategies collapsed overnight, leaving families with massive, unexpected tax bills. The same pattern is now playing out with inherited Roth conversions. Families converting traditional IRAs to Roth accounts, paying taxes now to avoid taxes later for their heirs, without realizing that the Secure Act's 10-year rule applies to Roth IRAs as well, potentially pushing large distributions into high-income years. The pattern is always the same. A tax advantage exists. Families discover it. Advisors codify it. Folk wisdom spreads it. Congress tweaks it. And then millions of families are holding strategies built on rules that no longer exist. In 2025, congressional proposals to modify or eliminate the stepped-up basis returned to the legislative agenda. If the step-up were eliminated, the calculus of every real estate inheritance strategy in America would change instantly. Families waiting for the step-up could find themselves holding enormous tax exposure with no escape route. The capital gains bomb is not a static threat. The rules are actively contested and subject to change. So let's land the plane. 3 things every homeowner needs to understand before transferring property to a family member. Takeaway 1. Never confuse avoiding probate with avoiding taxes. They are completely separate problems, solved by different tools. A revocable living trust avoids probate and preserves the step-up. A $1 sale or outright gift during life accomplishes neither. It sidesteps probate in the clumsiest way while permanently destroying the most valuable tax benefit available to homeowners. Takeaway 2. The stepped-up basis is worth real money, possibly more than any other estate planning decision you will make. If your house has appreciated, the unrealized capital gain is an invisible balance on your ledger. The IRS has a claim on it. The step-up at death erases that claim permanently. It is a one-time opportunity that disappears the moment you transfer the asset. Takeaway 3. Estate planning is not a DIY project. The stakes are too high. The rules are too complex. An estate planning attorney's fee is a high-return investment. For a $500,000 asset, it represents just 1% of the potential loss. The families who make this mistake are loving people, parents who want to protect what they built, people doing their best with incomplete information in a system that was never designed to be transparent. The tax code rewards those who can afford to understand it, and it quietly penalizes everyone else with a delayed bill. The $1 house sale is just one example.